All right, welcome into the Cow Guy Close. I'm Scott Shellady, also known as the Cow Guy. Thanks for tuning us in. We got a great show in store, so let's get going, right? My next guest, he's still a bull in this market, and I think it's hard not to agree with him. We have a Fed looking to cut interest rates, and after Friday's CPI, it's as if they were given the permission that the market could give them, right? We have an Atlanta Fed GDP now of 3.9%, an unemployment rate of last check around 4.3, 4.4%. We're going to hear about a new Fed chairman who undoubtedly will be more dovish than Powell, right? Now, the underinvested, they're going to keep buying the dips as we get closer to year's end. And the longer the shutdown goes, I think the more dovish the Fed will be. So my next guest, he likes this setup. So please welcome him to the show to tell us more about it. This is Mr. Eddie Ghabour. He's with Key Advisors Wealth Management in Lewis, Delaware. Thanks for showing up, Eddie. Appreciate you coming on the show. All right. It's a pretty good setup. It's a pretty good setup. I could agree with you, right?
This is as bullish as it gets. I mean, if you wanted to paint the perfect picture as a bull, you couldn't get it any better set up than this, because I can't find a time in history when the Fed was going to start really loosening monetary policy at a time when we're at all-time highs. The economy is going to be accelerating from a growth perspective next year. At the same time, pessimism from the investment community, to me, is still at a very high level, because it's been one of the most hated bull markets that I've seen in my nearly 30-year career. So when you have that balance of the liquidity going into the market with still a lot of pessimism, that tells you there's still a lot of folks on the sidelines that haven't bought into this bull market, and they will ultimately capitulate. And I think we're going to have a lot of runway to go. It's not going to be straight up. We know that. But to get this type of dynamic happening is a generational wealth opportunity, in my opinion. And lastly, tomorrow, if they stop QT on top of cutting rates, you're just adding more to the fire in regards to really getting this bull market continuing to go and surprise all the doubters and continue to make higher highs after every single drop that we've seen here since April.
Yeah, and just so that the viewers know, QT, quantitative tightening, basically what Eddie means there is if they stop this quantitative tightening, which is basically an easing, that's going to add more fuel to the fire, and I would absolutely agree with that. So my question to you is, and I've been doing it too for a long time, and I think we had 57 all-time record highs last year. I think we had 35, maybe 36 if you count yesterday, all-time record highs this year. And we've got a GDP now of 3.9%, an unemployment rate of 4.3 or whatever it is. All very good. I explain to the viewers of why we need to cut interest rates.
Well, that's the thing. You can make an argument that you really don't need to cut interest rates. But the reason why the Fed is going to do that is because they are worried about the labor market. And to your earlier point, the fact that this government shutdown has lasted longer than some thought is going to add more doubt. So the Fed is going to play it safe because they don't want to get blamed for a recession. So if there's a little crack in the labor market, they're going to go ahead and loosen policy. And that's essentially what they're doing. So, and they've been very clear that they're going to, the market's priced it in. And even if Powell only cuts one time this year versus two more times, we know the next head of Fed is going to be cutting rates. They're going to put someone in the seat that's dovish. So as I tell investors, it doesn't matter if you agree with what they're doing or not. You have to go where the money's going to go based on their policy. And when you do this, you're going to cause asset prices to really inflate. And then lastly, the key is going to be knowing when to sell, right? We are aggressive right now for clients. We're going to ride this trend until it ends. And it might not end to the end of next year or 2027. We will wait until the market tells us, and then we'll sell just as aggressively as we bought. But in the meantime, we do not want to miss the last leg of a bull market, because that is the most lucrative of them all.
So you're exactly right. And I want to add, you mentioned something in there called labor. These things aren't going to come to the market at the same time. So it's going to make the Fed, they have to be smart. They have to do their jobs. That's what they get paid for. But it's going to make it hard for them. Because I think, Eddie, if we do see the benefits from artificial intelligence, which I do think we're going to see, I don't care who you are. I think a lot of the CEOs out there are playing these cards pretty close to their chests, because I think that they think that they're going to have to let a lot of people go. I mean, we could actually see a labor market accelerate to the upside, an unemployment rate accelerate to the upside, but have productivity go up and have the market still do well and have the economy still do well. Then they're going to be kind of in this weird quandary of unemployment running away from them, but things are still okay. But I think that's going to be from AI. What do you think?
I couldn't agree more. And this is why the setup from a stock perspective is beautiful, because these cuts that are coming from jobs is not because of a recession. It's because the technology is making them more productive. Look what Amazon just announced in regards to job cuts. Microsoft has been cutting jobs, yet their profits continue to go up and stock prices keep going up. So it's going to be bad for a certain part of the economy, these folks that are going to lose their job because they're going to get replaced with AI. However, from a stock perspective, that's going to make these companies even more profitable. And the market is going to still demand rate cuts because of that labor market. So it's a perfect storm for these asset prices right now.
Yeah, because I think the job cuts hit the headlines before the productivity gains hit the headlines. So then I think that while things are still kind of strong behind the scenes, the Fed will be cutting rates, worried about labor, but and here come the horses when those productivity gains really start to hit the tape, if you get my drift.
That's exactly right. And one concern I do have, a longer term concern, is if you get growth really accelerating to the point that we think that it will, and you have a Fed cutting rates because the labor market is getting weaker, is you could see inflation reaccelerate sometime towards the end of 2026 going to 2027. Yes. And that's where we're going to have a really tough time, because they're going to have a weak labor market, but inflation really potentially getting out of hand. And at that point in time, if they are forced to raise rates, that will be a problem.
Yeah, but I agree. And that's the thing about it is, though, I'm going to put my tinfoil cap on real quick. We only have about 30 seconds. But you know what? I think that they're going to err on the side of inflation. I think they already have. I think that 2% is a pipe dream. It's not happening. Because you know what? With our debt and deficits the way they are, Eddie, we're going to have to inflate our way out of this. So I think, given a choice, they're going to have to let inflation run a little higher and a little hotter than they would like. 30 seconds to you.
I agree. And Powell has made that clear, that they keep saying transitory on the inflation due to tariffs and everything that they've said. But we're in a new normal of higher inflation than 2%. And it's okay. As long as the economy's growing, we will be fine. When that starts to decelerate will be when you have some problems. But right now, that is not happening.
Yeah, I mean, I think you've nailed it all the way around. We had 3% inflation basically throughout all of the 90s. So everything just was fine then, too, as well. Appreciate you coming on. Always great to have your content, Eddie. Great stuff, as usual. Eddie Ghabour coming to us from Key Advisors in Lewis, Delaware. We'll see you again next week, bro.